Welcome back, everyone. You trust that your cash is safe in the bank, and more importantly, that you can take it out whenever you want. That is the basic purpose of a bank, right? Well, here in 2026, that guarantee is showing some serious cracks. Folks are walking into their local branches expecting to withdraw their own funds, only to be denied, interrogated about their motives, or even having their accounts locked completely. And this happens without warning, sometimes leaving people without cash for weeks while the bank does an investigation. There are specific regulations, some brand new this year, and others you probably have not heard of, that grant banks the legal power to cut off access to your own funds. This isn't because you committed a crime, and it's not because the bank is going under. It is simply because an automated system or a cautious employee flagged your activity as unusual. In today's video, I'm going to break down 4 of these banking rules. We will cover what sets them off and exactly what steps you need to take to shield yourself before you become a victim. But real quick, before we dive in, please hit that subscribe button and ring the notification bell. The banking laws that impact seniors are shifting much faster than the general public realizes. And trust me, your bank won't be mailing you a simple letter to explain these updates. I translate these complex changes into plain English so you are prepared, rather than standing at a teller desk completely confused as to why your funds are locked. So subscribe, and let's get started. The first major hurdle you need to know about is a federal regulation known as FINRA Rule 2165. If you happen to be 65 or older and hold a brokerage, retirement, or standard investment account, this applies directly to you. This rule hands your financial institution the legal right to pause any transaction from your accounts if they suspect, even without hard proof, that you might be falling victim to financial fraud. They only need a reasonable suspicion, not actual evidence. How does this play out in real life? Let's say you call up your broker to shift $15,000 from an IRA to your checking account to buy a used car. Suddenly, that move gets flagged. The brokerage freezes the transfer while they look into it, leaving you with no access to that cash. This initial block can drag on for up to 15 business days, which is 3 entire calendar weeks, and they can extend it even longer if their review isn't finished. This isn't a computer error, it is the system functioning exactly as it was meant to. And as of January 2026, this rule grew much sharper. More than half of the states in the US have now passed or toughened up safe harbor laws. These are rules that actively push banks and brokerages to pause suspicious transfers by granting them legal immunity. They cannot be sued for freezing your money. This protection changed the game. Before, banks hesitated to freeze a valid transfer because of lawsuit risks. Now that they are shielded, tellers and automated systems are quick to hit the pause button first and ask questions later. The actions most likely to trigger this alarm are big, unusual withdrawals, sending funds to people not in your usual contact list, wiring cash to brand new accounts, or even just acting a bit anxious at the counter. A teller might be trained to view your rushed behavior as proof that someone is pressuring you. So, what is your defense? Whenever you plan a sizable or rare transaction, call your bank beforehand. A simple heads up. Just tell them, I am pulling out $12,000 next Tuesday to purchase a vehicle from a private owner. Making that quick phone call establishes a record that your action is planned and intentional, which drastically lowers the risk of a freeze. You also need to designate a trusted contact on your profile. This is a friend or family member the bank can call just to confirm you are safe. Many freezes drag out simply because the bank cannot verify your well-being fast enough. Keep in mind, this trusted contact cannot touch your money. They are strictly an emergency reference. The second scenario catches a lot of folks entirely off guard, and it can cause your account to be locked, your hard-earned funds seized, and spark a federal probe, all from a completely innocent habit. This is known as structuring, and it is a federal crime under the Bank Secrecy Act. To give you some context, banks are mandated by law to submit a currency transaction report to the government for any cash deposit or withdrawal that hits $10,000 or more. Most people have a vague idea this rule exists. What they fail to realize, though, is what happens when you attempt to dodge that report by keeping your cash amounts just under the line. For example, pulling out $9,500 instead of a clean $10,000, or making 3 separate $3,000 deposits instead of a single $9,000 deposit. Splitting a large chunk of money into smaller pieces specifically to stay under the tracking limit is a federal crime, even if every dollar is 100% legitimate. Government agencies like the IRS have actually pursued structuring cases against seniors who had absolutely no clue they were breaking the law. Look at a retired woman in Michigan who routinely withdrew $8,000 from her personal savings. money she had earned over her entire career. Her accounts were frozen, and $35,000 was confiscated through civil asset forfeiture. She was never even charged with a crime. The automated system simply flagged her pattern of withdrawals. It took her over a year of legal battles just to get her money back. Preventing this is incredibly simple. If you need to make a large cash transaction, just do the entire amount all at once. Yes, the bank will file a transaction report, but that is completely fine and normal. That paperwork does not mean you are in trouble. It just means the bank is following the law. The real danger starts when you break the transaction into pieces to bypass the system. Avoid doing that, even if you think it keeps things simpler or more private. The third challenge is something many seniors notice when visiting branches they have used for years, only to find the experience has completely changed. Major institutions like Chase, Bank of America, and Wells Fargo are rapidly converting locations into what they call cash light or appointment-only spaces, particularly where younger demographics favor mobile banking. In these spots, large cash withdrawals are no longer available on a walk-in basis. If you need more than $3,000 to $5,000 in physical cash, you might be told to schedule an appointment several days ahead or to take a cashier's check instead. Now, this isn't illegal. Banks have always had the right to manage their cash inventory. But for seniors who rely on physical bills, who dislike cashier's checks, or who need cash immediately for an emergency, this is a massive headache. ATM daily limits, which usually cap out around $500 to $1,000, won't help if you need several $1,000s within 24 hours. Here is what you should do instead. Learn your local branch's cash rules before an urgent situation pops up. Give them a quick call and ask if they require advance notice for withdrawals over a certain amount. If you frequently use cash for larger expenses, get into the habit of planning those withdrawals a few days ahead. It is also smart to keep accounts at more than one institution, like a backup credit union, so if one branch can't fulfill your request, you have an alternative ready. The fourth rule catches people with completely normal saving habits totally off guard. If you have a savings account or an emergency fund that sits untouched, your bank's system might be getting ready to mark it as dormant. The results can be brutal. Most state laws dictate that if an account has zero activity for 1 to 3 years, the bank must hand those funds over to the state government as unclaimed property. And here in 2026, banks have tightened the definition of what actually counts as activity. Automated actions like earned interest or scheduled dividend payouts don't keep the account alive anymore under these new rules. Only an action you personally start counts. This means if you have a rainy day fund you haven't touched in a while, it could be sliding into dormancy without your knowledge. Many people only find out when they try to use the account and see it's locked, or get a notice that their money is already with the state. Recovering funds from the state's unclaimed property division is possible, but it involves tedious paperwork and a long wait, not ideal when you need cash immediately. The fix is incredibly easy. Just log into your accounts at least once a year and do one manual action. Move a few dollars in or out, or even just check your balance manually. Anything that shows intentional activity resets the clock and keeps the account active in the system. To recap the whole picture, FINRA Rule 2165 and new safe harbor laws across the country let banks freeze transfers for up to 3 weeks on mere suspicion of fraud. Your best shield is notifying the bank ahead of time and adding a trusted contact. Structuring or breaking up big cash transactions to avoid the $10,000 government report is a federal crime that can cost you your savings through asset forfeiture, even if the money is legally yours. Branches are restricting physical cash and demanding appointments, so plan ahead and have a backup account ready. Finally, forgotten accounts can be swept away by the state, so do one manual transaction a year to keep them safe. Subscribe to the channel, share this video with friends who rely on cash or keep old savings accounts, and I will see you in the next one.